Let's get back to China and the trade truce expectations. We are expecting President Trump to be briefed by his trade team and then the announcement on China for its August 12th deadline. What are your expectations?
I think the generally market expectation is the status quo maintains. Right, so the 90-day deadline will probably be extended, and the existing tariffs will probably be kept in place, whereas there will be more detailed discussion to be worked out on all the specific export controls and other implementations. I think if U.S.-China can negotiate down the 20% fentanyl-related tariff, it will be a big positive surprise to the market. But on the other side, if the 90-day is really a hard deadline and the tariff rate on China snap back and add another 24%, it will certainly be a negative surprise.
Now, in all the trade deals that we've seen so far, be it South Korea, Japan, there's these purchase elements to it, the investment also that goes into the United States. The last time that China had its trade deal, it didn't meet its requirements. So, partly to do with the fact that we had a global pandemic. So it didn't make good on that purchase agreement. Do you think that the China deal has that part of it as well?
Well, I don't think there is high expectation on that either, because realistically, the biggest items China can purchase from U.S. is typically the aircrafts, the energy, and the agricultural product. But if you look at aircraft and energy, like Boeing's capacity is fully sold out by end of 2030. So realistically, China can't get enough of the purchase to balance the so-called trade imbalances. So I doubt this purchase will be a big element of this time's trade deal. And then on the outbound investment side, I think there are enough regulations and concerns within the United States to ban or restrict Chinese investment. So again, that part, if we can get some progress, it will be fantastic.
So we're waiting and watching to see. And the impact on the Chinese economy, we just got the latest reading, manufacturing activity from Caixin, 49.5. So this is in contractionary territory, and it is similar to the official reading that we had yesterday. In terms of the data that you're seeing and the response that we got out, the readout from the Politburo, are they not so concerned about the tariff war and the impact on the economy?
Yeah, it looks like equity market and also the policymakers are both feeling more relieved after the past few months of data point. For first half of this year, China's export was still growing at around 6-7%, depending on whether you're using RMB or US dollar year on year. U.S. component as China's total export is down from last year was still 14-15%. By first half this year, it's down to 12%. So despite reduced, significantly lower U.S. export, China's total export was doing fine. Now, was that all because of front loading? Was that all because of transshipment? We need to find out. But as of now, I don't think market or the policymakers are very concerned about, the economy as of now.
In the previous two Politburo meetings, it was external shocks and sharply changing external environment. This was in the readout, and this was missing this time in the latest readout. What would be the main headwinds for the second half of this year?
Currently, the obvious downward trend is happening in the property market, right? We had some recovery in end of last year, beginning of this year, but starting from March, April, property market transaction and prices are falling off pretty quickly. So again, if property prices is falling, it's going to have a negative wealth effect on the household and potentially impact the consumption. Export, even though so far so good, but we don't know whether these transshipment tariffs, for example, and if the front loading really would mean that by second half of the year after the summer, export will slow down much faster. So that's also something to watch. And I guess finally, on consumption, domestic consumption itself, from second half last year, China launched those trading programs, consumption subsidies, which could again front-loaded some of the demand, right? You bought an aircon last December, you're not going to buy another one, even if there are subsidies coming. So we're getting into the higher base effect for some of the domestic consumption, home appliances, EV3 product. So domestically, there are these three areas to watch out for, right? The property, the consumption, higher base effect, and and externally there is the export situation, and it doesn't look like we're getting a strong policy stimulus in the short term.
In terms of policy, they're also working on anti-involution. How are they able to make an impact there?
Okay. Anti-involution has been the hottest topic in the past months, right? I got inquiries from Italy-based client, Paris-based client, Middle East client, all talking about China anti-involution. Hey, is that going to turn around China's PPI? When? Which month? I think expectations very high. I think it is a very important task. And it's great that Chinese government is officially addressing that. But I would say this is probably more a 3 to 5 year mission, not something we can expect a quick turnaround in 3 to 5 months. I think many market participants are already aware that one is, the overcapacity related sectors this time is actually much broader, right? 10 years ago when they did the supply side reform, it was the old economy, coal, metals, and mining. But this time we need to be worried about, the solars, the lithiums, the batteries, the EVs, many of the so-called new economy, green economy sector, which local government supported, subsidized over the past few years, also is quickly getting into overcapacity. So what do you do there? And also, as some of these sectors were able to export, the pushback from the local government, from the private companies will be high. Say, hey, we just newly built up. We are not pollutive. We are green. We are strategic new sectors. Why you want to shut us down, right? And the second part of the challenge is that 10 years ago when China did the supply side reform, there was also demand side stimulus. So in 2016 to 17, China has around a big property stimulus to drive the property related investment, and that drives the demand, right? And there was also accelerated local government SOE capex activities. And finally, 2017 was a global synchronized recovery. So there was the export recovery. This time, are we expecting similarly strong export recovery, property recovery, SOE or local government investment? Harder to say. In fact, the July Politburo meeting, the notes actually reiterated to control the local government hidden debt. Right? They are actually very mindful of the local government debt burden. And finally, this time when they say anti-involution, it's not only capacity reduction. There are other metrics, policy measures, for example, reduce the government subsidies and support, reining in the local government investment, which has become a problem, right? Every province, every county want to build solar 5 years ago. AI now, right? So when the government subsidy is reduced, it's probably going to have a broadly negative impact on many companies. In fact, when we look at the A-share listed non-financial companies, these subsidies and rebate is now 12% of their pre-tax income. Also, there are measures to support the supply chain SMEs so that, the industry leading companies, when they get into the price war, they don't pass on the burden to the SMEs, which has weaker negotiating power. So whether it's in e-commerce, online platforms, right? You're doing this price war, but you need to make sure you don't pass on the price competition burden to your merchant on the platforms. Mm-hmm. For auto, stop squeezing your auto dealers and auto component suppliers. You need to settle the account payable in time. And these measures are also marginally negative for the large listed companies we look at. So this time, I think it's much broader industry coverage, much broader policy focus rather than just a takeout supply. And in the past months, we saw commodity price surge, stock price surge, which is in recognition of the right policy direction, but it could be counterproductive in the sense that for companies that was already on the verge of bankruptcy, suddenly your coal prices rebounded, your lithium prices rebound. They might say, hey, I can survive another several quarters. This might be counterproductive in terms of industry consolidation and taking out overcapacity. So we advise investors to be very mindful not to chase the current rally, especially after some of these prices went up 30-50% in the month without fundamentally addressing the supply-demand imbalance.